Hey everyone, and welcome back to Money, Mortgage, Moving Out. I'm Sam and this is Pip.
Hi!
In today's episode, we are going to be talking about investing.
Now that we have talked about how to budget, where to save a little extra money and cleared any debts that we might have, it is now time to start making the most of our money.
Basically, with investing, what you do is you put a bit of money into a company and buy what you call a stock. Now this stock can make you money, but it can also lose you money.
And now that we have a basic knowledge of investing, it's now time to delve a little bit deeper. It is no secret that some people are unsure when it comes to investing.
But full-time employees are automatically put into a workplace pension.
Even if they don't understand the first thing about a workplace pension, they are invested in the stock market. So if you are auto-enrolled and you have kept your pension, you are already investing.
What it seems like is people who are confident with their money tend to invest.
But don't let the idea that you need to know more about money put you off investing.
And don't let other people put you off by saying it's risky, because there are lots of ways to invest.
Buying and selling shares in individual companies can be fun and interesting if you have time and spare money.
But if you want to invest money that you cannot afford to lose, then we say probably don't invest it.
Bitcoin and cryptocurrency are great if you like gambling, but probably not somewhere to keep your life savings.
There are more steady ways to invest money via investment funds. Either by letting someone choose where to invest your money, tracking a stock market index, or doing a bit more research and picking your own funds. Although it feels safer to put your money in a bank, you're more likely to lose money because of inflation and rubbish interest rates. In order to invest safely, you need to be prepared to lock your money away for a long period of time. Ideally, you want it to be as long as possible, but 5 years or so is good enough. And before you lock your money away, you should make sure you have an emergency saving fund. Not everyone has spare cash, but if you do, and you want to make it a little bit bigger, you should give it a go.
Investing in a stock market is great for your pension, for your children, and a midlife goal. But unless you want to buy a house in your mid-40s, it's probably not the best idea for a house deposit. There is no right time to start investing, but the younger you are, the better, as you have longer to ride out the ups and downs of the market. It's hard to define an average interest return, but many experts tend to use 4 or 5% as a fairly conservative estimate for many returns. Estimate of returns for a long-term investor who takes a reasonable amount of risk. But it all depends on the risk you take and the performance of the stocks or fund managers.
Assets include cash and properties. You're investing when you buy a property as you hope the price will rise, and when you sell it, you'll get more than you paid for it. You can also invest in commercial property like offices or shopping centres via fund, stocks, shares, or equity bonds and commodities. The most successful investors have a mixed portfolio, so they have a lot of different assets. So if one falls, you've got another one to keep it upright.
Companies need cash to start up, grow, survive, and make a success of themselves. You can't start a company with absolutely nothing. You need to find money or capital for things like materials, packaging, and products. An option is to sell little parts of your company in the promise that if it does well, you will make more money. And those who own it can sell their shares for more than they paid for it. Shares are known as equity, and if you own a share, you have an equity stake in a company.
A company is either private or public. Now, a private one will issue their shares to people like friends, family, employees, or even professional investors. You cannot actually buy shares in these companies unless they go public and becomes a public limited company. Companies tend to do this to earn a bit more money. From lots of investors, they have to be a certain size to do this. Once a company has gone public, anybody can buy shares as long as they're available. The buying and selling is done through a stock market, which is composed of stock exchanges. Stock exchanges are traditionally where people went to trade quoted shares, though these days it's usually done online.
The stock market value of any company is based on how much its shares are worth. In total, the value of each share, and therefore business, rises and falls depending on how many people want in on a business and how many shares are available to buy. Shares may be divided into different categories: defensive or cyclical, growth or income producing. These are based on the characteristics of certain types of companies, what product or service they are offering, and whether it is more or less likely to be popular at certain times. Defensive shares are shares in companies that do well when the economy does not. Cyclical shares do better or worse depending on how the economy is doing. Income stocks may refer to shares in long-standing familiar companies. You can take a bet that they will stick around for a while longer and continue to bring in a steady return on your investments. As well as benefiting from any rise in value, investors also get a regular return on income stocks known as dividends. They are regular payments of a cut of the company's profits. Handed out to shareholders, you can take them out as cash or reinvest them. To make a judgment on how different types of shares are doing and how the overall stock market is doing, you need some kind of measure, and this is indexes or indices.
Shares aren't the only thing shared on the stock exchange. A bond is basically like a loan. It's where a company has no interest in selling shares, but they do need to borrow money. Small companies might go to a bank for a loan, but for the larger companies, these loans are expensive and restrictive. So they issue bonds. When you buy or invest in a bond, you are just agreeing to make money through interest. Interest payments on bonds are called yields or coupons, and the loaned money is paid back by the company who issued the bond after a certain agreed period known as the maturity date. Governments also do this.
Bonds are also known as fixed income securities, because when you buy one, you know exactly how much money you're going to get. The interest payments or yield is laid out at the beginning of the agreement. Bonds are considered less risky than shares because you know how much money the company will make unless it goes under. And if it does, it's obliged to pay out what is left to the bondholders before the shareholders. Government bonds are thought to be even safer because they are even less likely to go bankrupt. Bonds can be bought and sold. Commodities are goods that are interchangeable and does not vary a great deal no matter who has produced them. These can also be bought and sold, and the prices vary depending on a lot of factors.
You could put all of your savings into buying shares of one company, but you need to think about how risky that is. Because if that company goes bankrupt, your shares are worth nothing. Or the company might have a bad year just as you want to withdraw your shares, making them worth less than what you paid for. So to avoid this, you invest in lots of different companies. So maybe you want some safe corporate bonds too, and you know how much yield you will get over the next few years to offset any uncertainties surrounding the performance of your shares. This process is known as diversifying and is the key to investing safely and profitably. Investment funds help you diversify. They are a pot in where lots of individual investors can pool their money, handing it over to a fund manager who then choose where to invest, minimizing the risk and maximizing the profits. They will pick a mixture of shares, bonds and commodities, and the decision of what to invest in is taken away from the investor. Instead, the individual investor makes a decision on what kind of investment fund they want to put their money into, and the investors receive a proportion of the money that the funds hold. There are lots of different investment funds that are available that specialise in different areas, and different types of investors. You can also hold as many as you want.
How to start investing. Firstly, start by thinking why and what the reason is you want to invest. This will help inform your decision on how much risk you're willing to take and when you want to withdraw your money. But remember, you want to invest for as long as you can. The longer you invest, the more likely you'll make more money. The advice is put your money in there and leave it there and try not to look at it too often. Also, don't invest when things are good because that will make it pricey.
How much can you invest? It is a myth that you have to be rolling in it to invest, but it is always wise to have some extra funds in an easy access saving account. A lot of advice says investing little amounts, maybe monthly, is a lot better than investing a lot of cash. For instance, if the stock market goes down, you simply buy a lower share next month and it should all even out.
When you put your money into an investment fund or buy shares directly, you have to pay a fee for your investment to be looked after. It's important to consider when choosing where to invest how much you want to pay in fees, as these can erode your savings over time. These fees will include an investment management charge, which is deducted from the value of your investment to pay for the cost of selecting investments for the fund and various admin fees. You'll most likely invest in your fund, or if you're feeling bold, buy individual shares through a platform or fund supermarket. These companies will administer your investment and let you manage your portfolio online, offer useful tools, advice and graphics to show how your portfolio is doing, what kind of investment options you have, and so on.
Some funds are more expensive than others because they are actively managed, meaning they are run by a person called a fund manager who actively picks what funds should be invested in. They do a lot of research into companies and have a track record of profitable decisions to pick the best selection of assets. They produce a lot of information for you to look at as the investor to decide whether they are right for you. However, someone picking the right stocks last year doesn't mean they're going to do the same this year. They are basically just guessing. Some people think active management is basically a waste of money and you cannot beat the market, and that the only fund you'll need is a tracker fund. A tracker fund is a passive one, as it tracks indices because no one is doing any research. These are usually the cheapest ones to invest in.
When choosing a platform where you can invest funds in, you need to consider the total size of your investment pot and how often you'll be buying or selling shares or funds. Some platforms charge for trading and for how much support you need. Some platforms just present you with thousands of investments to pick, and others give you online tools and helpful information to help you make your choices. There are three main types. Do-it-yourself platforms that offer the biggest choice and are set up for confident investors who want to make all the decisions by themselves. Do-it-with-you platforms with more information and tools, and suggested lists of best buy investments, and a range of investment funds by risk profile for those who do not have the time or confidence to choose all of their investments themselves. The Do It For You platform, a ready-made investment portfolio that takes away any responsibility for the investment decision. Beginners may feel happiest opting for this platform.
You should consider tax when investing. Though your returns will not be huge when you start out, you are taxed on any income through dividends and the growth in value of your investment. You do get a tax-free allowance for this, but it is wise to start investing through a stocks and shares ISA, where all of your returns are tax-free.
Investing can be really confusing, so it's always important to do your research before you start to invest.
We've just given you a simple rundown of investing, but it's really up to you where and when you want to invest.
We hope that you have enjoyed this episode.
And don't forget to like and subscribe, we really appreciate that.
Also, make sure you head over to Instagram and TikTok to see what we're doing over there, and that is @Money Mortgage Moving Out.
But for now, we'll see you next time.
Much love.